All right. Hello, everyone. Welcome to this session titled The Dawn of the Yield-Bearing Stablecoin. Today, we're going to be examining the potential of IBTs, so interest-bearing tokens, on enhancing composability and liquidity in DeFi. I'm your moderator. I'm Amal. I'm on the business development team at Redstone Oracles. We're the fastest growing modular oracle. We're live on over 60 chains, pricing over 1,250 assets, and focused on pricing yield-bearing assets and collateral for lending markets. Today, I'm joined by my esteemed fellow panelists. I'll let them go down the line and introduce themselves, starting on my right.
Thank you. Hi, everybody. I'm Ethan, one of the core contributors for Ebisu Finance. We're a CDP on Ethereum that lets you borrow dollars against various Bitcoin, ETH, USD pegged assets at the most competitive interest rate. And some of our collateral are yield bearing. So that's our relation to the topic.
My name is Gerrit Hall. I'm here on behalf of Curve Finance, who is also generously throwing this event. I've been working with Curve on developer outreach and relations, so I've done a lot of tutorials on how to integrate with Curve using Titanoboa, Viper, Ape Framework, all fantastic frameworks. And in my free time, I blog about Curve, so I'm very much Curve maximalist.
Hi, my name is Gaspard Peduzzi. I'm one of the co-founders of Spectra protocol. We introduced principal tokens and yield tokens back in 2020 under the APY name and rebranded it to Spectra, which is doing permissionless yield tokenization.
Hey, I'm Figue, one of the co-founders of Paladin and Rings. We basically try to help stablecoin scale, first with on-chain liquidity for Paladin, and then as a utility sink, mainly on Sonic, with Rings, which is basically a meta stablecoin.
Okay, thank you, everyone. So just diving right in. For a bit of context, with crypto going through a massive systemic shock over the past 6 months, and a lot of the political landscape in the US shifting increasingly favorably towards crypto and its long-term viability, there's been some talks that the DeFi sector that ends up mirroring traditional TradFi yield-bearing strategies the most could end up being one of the big winners of this shift. Hence, bringing us to the topic of the dawn of the yield-bearing stablecoin. A lot of the questions will be addressing how DeFi assets like stablecoins can be valued specifically under these traditional financial valuation models, where the asset value is now tied to the future yield. Well, but diving into the first question, as more sophisticated and traditional participants enter the market, something we're already seeing now today, do you guys expect the demand for yield-bearing stablecoins to increase substantially? Why or why not? And what effect can this have on the space? I'll just kick it off to my right and see where we go from there.
Yeah, I think broadly, we've seen a proliferation of yield-bearing stablecoins, especially I think it was mentioned in one of the last talks when you want to prevent devaluing of your assets relative to inflation. Having some yield on your wealth is nice, but I would add some nuance. When we say yield-bearing assets, it's a broad category, and it's really important to understand how is the yield generated, and also how is the underlying stablecoin generated, because there's respective risks to both how the stablecoin is produced and the strategy of the yield. Risk in terms of how stable this yield is, how scalable it is, how it performs in various macroeconomic contexts. So I think broadly yes, but it needs a more nuanced risk underwriting.
Yeah, I agree that nuance is key, and it's really difficult for people in the space to understand because APYs tend to be correlated with risk, and yet people are just so excited about high APYs that it kind of blinds them. And that leads to a lot of tragedies where people keep getting greedier and greedier and go for the riskier and riskier attempt to try and get yield, but it does continue to work. So I don't think we're going to ever get away from that fully. And I don't think that institutional players are necessarily different from retail on this front. I think that retail is very risky with their own funds, but I also think that we saw during DeFi summer, a lot of institutions saw high APYs and they got excited and they moved in. And they might be cautious now, but at the end of the day, high yields is like a bat signal. Once you see a high yield go out, it's an immediate signal for people to swarm and try and attack it.
Yeah, definitely agree with what was said from a perspective of a protocol integrating yield sources. We have most of our TVL and stable coins at the moment. We've seen this market completely exploding, lots of different protocols, like Ethena doing tremendous growth on that aspect as well. But from the institutions that comes and try to use a protocol, we see a lot of demand on the fixed income instruments. So maybe joining what was said previously, they want to have more control, more certainty over the return. And DeFi is still like a very wild environment where you see like a yield, non-sustainable yield. And not only we see the demand for stablecoin increasing, but also stable yields. Yeah.
I think it's important to put it in perspective in the sense that it really is the dawn of the yield-bearing stablecoins. Right now, we just crossed a huge threshold, which is 1% of the dollar M2 supply is in stablecoins. So that's huge. That's $220 billion. On top of, on this, how much is yield-bearing stablecoins? The answer is less than 10 billion. So we actually have less than 5% of the stablecoins that are actually yield-bearing today. And 80% of them is actually just Ethena, then it's usual, and then it's projects that are lower than $1 billion. So there's massive amounts of money in that ecosystem, for sure. The only people who are not sad today are the ones who are building stablecoins, so it's most of you guys, considering the market. But the reason why I'm going to this is there's a lot to be built. Like, do people actually care enough for yield-bearing stablecoins to take over, or are payments instruments like Circle and Tether, because that's what they are, will they dominate? In a sense, it's about distribution, right? They were first mover. They have a huge advantage. Can the yield-bearing stablecoins, by externalizing and giving to users their yield, compete and win? I don't know. Maybe it's too late. I think it's someone else here has better insights than me on this.
I'm curious why you think it's too late.
I'm not necessarily saying it's too late. I'm hinting at the fact that it could be, because if you look at the stablecoin growth over the past 2 years, it is 99% Tether and Circle. Like, we're self-congratulating what Ethena did, and it's impressive, what Usual did, and it's impressive, all of these in terms of growth. But how many other stablecoins have the reach to actually go to 1 billion and over? I think it's a lot about distribution. I'm really speaking for experience. We've been working with stablecoins for more than 3 years. We released our own meta stablecoin. It's not a stablecoin, on Sonic, 2 months ago. And we're trending roughly at $120 million TVL in 2 months. And this only works because it's happening on Sonic, and they have a distribution channel that enables us to go to that scale. So it's not really as much about the yield as it's about distribution.
Yeah, please.
I think it raised a good point. Like, what's the point of stablecoin? I think there's 2 use cases: payments and then savings. For payments, you want to pay someone in an asset pegged to $1 because that's what we do business in. For the savings use case, that's where yield is nice. You want your money to grow relative to inflation. But the key question he raises is, does the savings need to be denominated in a yield-bearing coin, or can it be in a dollar that is lent in a yield strategy, and you withdraw and you earn yield on you withdraw more than you put in, that's yield. And like, at least from our perspective at Ebisu, it's like yield-bearing stablecoin is useful if you want to collateralize with that yield-bearing asset. But if you're not trying to collateralize and you're just trying to earn yield, yeah, it's a nice question. Like, why would you have a yield-bearing asset versus just deploying a pegged asset into like a yield strategy?
I'd add to this and just say that another really emerging use case for stablecoins is actually on-chain settlement, which we're starting to see evidence that this is why some of the stablecoins are being minted, is for the purposes of settlement. So, I mean, I think that's like exciting. We're seeing new stablecoins filling out their use cases.
Yeah, and we're seeing new sources of yield, right? Because Spectra is specialized in tokenizing these yields. But initially, when we started, like last bull market in 2021-22, we had swap fees from a lot you could get, for example, from Curve, and lending fees. And that was the 2 origins of yield. Now you have delta neutral strategies like on Ethena, you have T-bills, and you're going to have more and more sources of liquidity. So what becomes interesting is that you can have diversified access. At least that's what we've been focusing on for the past few months is, hey, there's a huge amount of interest in stablecoins. It's obviously a superior technology to the dollar equivalent that you can have in a bank account. So the question is, what's the best service that you can use? And there's hundreds of solutions. Our answer is, maybe we can offer an aggregation service that just gives you the better average of all the yield opportunities, risked, managed, of course, on the market. And that's what we've been trying to bring to the market.
Yeah, I think kicking off what you just implied, looking at like the aggregation of different yield strategies, let's talk about the design of yield-bearing stablecoins from an end user perspective. In your guys' discussion with users, what demands have you seen when it comes to yield structures? And are there fluctuations in user demands based on different yield strategies? Like, do you expect this to change long term? How do you expect it to play out?
Yeah, so I think like yield-bearing assets is like ice cream shop. There's different flavors of ice cream. It's all pegged to $1, but the flavor is different. Like the type of yield it offers is different. Like he said, it can be like T-bill, delta neutral, from lending, whatever. And it's up to the user. At Ebisu, we let the user choose. Okay, what flavor of ice cream do I want? And then they can bring it to us, and they can borrow against it. I think they would want to borrow against the yield-bearing asset because if the yield is higher than the interest they're paying on the loan, then the loan self-repays. But yeah, I think. I guess it's up to the user. Like they're the one who gets to choose what kind of types of risk they want to take on. Yeah.
I mean, it's very interesting because there are so many different flavors, and I wish people did more research into it. Is my like one wish for people, because I really feel like that just boils down to, oh, that's 20%, I'll do that, and that's 5%. There's so much going on under the hood. It's just like fascinating mechanics. It seems to me that like kind of building off what Figue was saying earlier, like we have this like really interesting situation where the like basically stablecoin is an insanely profitable business. Whether you're Tether, whether you're a small protocol just getting started, if you can get a stablecoin off the ground, it's great. Tether's not giving away any yield, and they've made that work for them. They got 150 billion roughly in their market cap, and they've done it keeping all the yield for themselves. And then at the bottom, not to like, we're like compared to Tether, we're all on the bottom, and we're figuring out where we can strategically give out that yield within our ecosystem to best grow. And as long as there's people like us innovating and like trying to like dish out yields in various ways, I think it doesn't matter necessarily whether it comes from a delta neutral strategy or whether it comes from a lending protocol, sharing some of the yield. Like, I think the important thing is like if it's a good sustainable mechanism and you're willing to reshare it with users, like we're going to see growth in this kind of bottom rung as we kind of work to get our way up to the big boys.
Gerrit, I'm curious, just to double click on what you said. You said you wished users did a little bit more research on these strategies. So would you say that like, at least the state of users right now is that they're a bit more reactive to what the market presents rather than like stablecoin issuers designing yield-bearing strategies based on user requests? Like basically the question was, how do you respond to users' needs? Is the answer that users are actually just responding to what we put out?
Yeah, I mean, in the talk I gave earlier, like I kind of gave the analogy of a yield-bearing stablecoin is basically like you aim a fire hose of money at your stablecoin and dare people to mint it. And people will take you up on that down to like a certain kind of like wherever the risk-reward ratio isn't quite there. So for like, a safer stablecoin, that's probably going to be nowadays like 7 to 11%. If it's like a completely risky mechanism, then it might be 50%. Now, I wish is that the people who saw the 50% and still aped, like I wish that they actually did the research at that point to say like, why is this so high? Because usually if it's sitting at 50%, it's probably not because you just like stumbled across a gold mine. It's probably because smarter people looked at it and passed.
Yeah, can also be new, right? There's a whole attention game in crypto where distribution is king, and there's so much noise that signal is extremely hard to find. One interesting thing I've realized recently is that we've associated leverage with a degen behavior. The thing is, most of the hedge funds are 7 to 10x leverage on all their stack when they're doing ETH or stablecoins or dollar or Forex. That's an average.
Degens?
No, I'm saying leverage is the common farming method. That's what's underestimated. The capital ratio, Basel III capital ratio, imply I think you need 5% leverage ratio, which means you're not allowed to lever up to over 20x. You're not allowed to. That means that banks on average, depends on the countries and the types of banks, they lever, I think it's between 8 and 12x, depending on the opportunities. Like the job of a bank or even a hedge fund, that's why it's called hedge, is that you're going to take very little risk and you're going to lever it up to maximize the yield you're getting. So while we're focused on huge numbers for yield-bearing stablecoin, and that's, I think, something very interesting with Ebisu, for example, you can actually just get a small yield and lever up, but it's not for retail users. Like, honestly, finance as a whole was not built for retail users. That's why in traditional finance, you have so many intermediaries. I'm not saying we should not interact with them. I think the opportunity of doing it is great, but I'm trying to sell that complex strategy. It's in the name. They're complex.
One of the cool things I've seen emerging with Curve Llama, and I'm sure you can like weigh in on this in Spectra, is like stablecoin leverage trading is actually an amazing strategy because a stablecoin will like depeg by a penny, and if you think that's actually a really solid stablecoin and it's going to repeg, you can lever that up 50x, and like that becomes pretty significant. So, and I'm sure you've seen similar stuff with yield trading on Spectra, like
Yeah, definitely. It's like I would say there is like leverages associated to different things in DeFi, and I think DeFi is very powerful in terms of composability. And when you see Athena's growth, like really, almost parallel to Pendle growth, for example, in terms of integration, and that's kind of leverage where you just stack yield as well, and like from different layers is also a great way to be more attractive to. Insert your token at a lower level of the chain, make it completely. I mean, we've seen, like USDC yield, everything is getting arbitrage eventually, and you see like the interaction between first the initial yield strategy, the stablecoin interest-bearing token, and then like a protocol producing basically bonds, like yield tokenization, and that integration into lending market, and like that kind of triangle produced like. I guess is a great factor of growth for most stablecoins at the moment. It's also some kind of leverage. It produces its own risk, but I think like that's maybe something that more yield-bearing stablecoin, DeFi stablecoin have been using a lot. That maybe more traditional conservative other stablecoin, that are more on the user payment side, have not been tapping too much into.
Yeah, I think that brings us to an interesting point about the seasonality of these yield-bearing strategies. Given like the vast variance among yield, like in strategy of yield-bearing stablecoins, how do you see these new institutional, traditional investors that have moved into the space reacting to this variance, if at all?
Real quick, I think like we said, okay, consumers ape whatever's the highest APY, and maybe that's true for some degens, but majority of the wealth is not controlled by degens. It's like by big boys who are really smart. And when I talk to like institutional LPs, like they're going into the weeds, understanding how the yield is produced and what is the risk reward trade-off. And I think so they understand it perfectly. They can respond to seasonality quickly. That's their whole job. And for the normie user, maybe there'll be just like abstraction layer, like a vault or something, and the vault rebalances based on seasonality to ensure the end user is getting the best bang for their buck, and the curator is like clipping a fee in the process. That's kind of where DeFi is. We've seen DeFi trending. Yeah.
So I think on the question of seasonality, it's really interesting because, as we all know, crypto is so temperamental. Like it was just a few months ago, we were convinced we were in a bull market and it was going to gigascend, and the like quote unquote like safe DeFi rate on chain at that point was kind of set by Athena. So it was not uncommon to see 20%, 30% yields on stable coins because there was such intense demand to borrow. And now here we are just a few months later, and it's a brand new season. We're all bearish. We think it's going to zero. And all of a sudden you can get like pretty good rates on this. So I don't know. I don't know if there's any wisdom in that.
I don't agree. I've kind of stopped thinking about the bull/bear thesis because I was one of the first in denial, thinking we're in a bear market and nothing was happening. And then you meet your friends on Solana who were all getting stupid rich, farming 30%, getting crazy airdrops, doing meme coin trading. Then it moved to Base. Now it's on Sonic. The truth is that capital is moving around. It's very liquid. So either you stay loyal to a chain, and if it's worth building on, if it's worth having the capital, and Ethereum is obviously the most liquid one. But the truth is that basically trends move, trends change. It's the whole point is where are things happening right now? And right now it's happening on Sonic, to be honest. And it's going to keep moving around. That's the thing. The whole job of a foundation, of anyone, is making these. But our job as project is to have a very strong value proposition, being able to work with these chains in general, and just having a stable product. Yield-bearing stablecoins are not going away. The problem is adoption. How many people are going to use yield-bearing stable? Why do you have USDC in your wallets instead of SCRV-USD, SDAI, even SCUSD, which is our meta stablecoin? The reason is simply we think it's safer, it's more liquid, there's more DeFi integrations. That's the whole thing, right? So right now, if there's $220 billion of stablecoins, if there's 1,000 billion, what does the ratio look like? And if it's still this small, we'll already be very, very successful because it's a very profitable industry. probably the most profitable actually in crypto right now, but will have lost in the sense that yield-bearing stablecoins will not have taken over. And I don't necessarily think that they can win unless they focus on the distribution channels, or at least the right partnerships.
I agree with you, and the fact also that, the best yields were being collected and funding rates arbitrage, and so obviously like Isina was driving, the standard of like what you would be expecting on a stablecoin, but also that's just like the tip of the iceberg. And as you mentioned, like capital is moving, and one of the reasons why capital is moving is like this is the public APY that we see, but when you're talking about stablecoin project, like there is the APY behind the curtains, there is the points, there is like the VC capital being flowed into our yield, to be able to get market shares as well. And like, I guess that's also seasonal in some ways because, this capital can only flow during a certain time. And at some point, you have to be back to an organic generation of yield. And so I think that's where like just having also more yield source, you can diversify a bit. But until now, like funding rate arbitrage have been producing such a high yield that it's hard to compete. But I think it's also, as you mentioned, a question maybe of where do you find the yield and whether or not it is organical as well. That's something we see a lot integrating projects like this is projects, close to TGE, spending a lot on APIs is a great integration for us. But, we also know that after TGE, the yield will not be the same. And even with the same yield, you won't have as much LPs because those LPs add different incentives that the public cannot see.
Yeah. It's true that when we meet yield-bearing stablecoins, a lot of what we see today is incentive infused through points, through tokens. It's not that it's unhealthy. It's just that the more you're emitting token, the more price pressure you're going to have. So it's going to kill you eventually. We've learned that the hard way. And you need endogenously, like you need a real source of yield. Like SCRVUSD has its own source. Sky has its own, etc. All of these projects, they need their own. And I think what's interesting is that there's going to be tens, if not hundreds of different sources of yield for stablecoin. And then, as you mentioned, as a retail user, which one do you choose? Probably going to want someone to choose for you, get the best yield for you. And that's what we're trying to get to. So it's a safe place for people to get that yield.
Gerrit, Ethan, anything to add?
What was the question? Sorry.
No, just anything to add before I move on to the next question. All right. I think, Figue, I want to tap into something that you're mentioning here, which is the key point of distribution, right? We're seeing a lot of established brands move into the yield-bearing space, and these brands have strong narrative onboarding funnels, and they have massive stablecoin distribution. I mean, for example, USDS, formerly DAI, traditional USDC, Athena. With all of these big players, how difficult would you say it is to break into this market? And how do you approach go-to-market strategy in such a highly competitive environment? Essentially, what you've been saying this whole time, distribution. I'd love to hear you kick it off, Figue, since it's been a key point you brought up.
Either you have your own distribution channel. So the example is PayPal. There's been rumor that Revolut is coming in the business. If you're in the audience, message me. But in general, all of these guys, they have a huge edge because they already have the distribution channel. So it's very easy for them to come in and do it. And that's why I think every fintech, every bank has an incentive in creating their own stablecoin in some way, shape, or form, and not partnering with someone else. That's the limiting factor. For a normal stablecoin, let's be honest, today, if you're creating your own stablecoin, it's almost impossible to break in. You're going to need to partner up with the distribution channel, with the blockchain. That's what we've done with Sonic. With a very large fintech, with a bank, with anything, you're going to need that. The exception that proves my point, I think, is Aave. Aave is the largest lending protocol. They've decided to launch their own stablecoin. Some people think Aave is spending a lot of money on Go. I have bias. I'm one of the contributors helping around that liquidity. But the truth is very simple. Today, Aave makes between 2 and 10% of the interest rate that are being paid on USDC and USDT loan. There's roughly 15 billion of USDC and USDT loans, okay? So it means that if instead of doing 5 to 10%, they're lending out their own stablecoin at the same interest rates, they're multiplying their revenue between 10 and 20x with the same lending capacity. Zero growth, just sending the asset means that their revenue goes to the billions. It's insane. So they're spending a lot of money, but it's been growing progressively, and they are only able to do it because they have a lot of funds. So if you don't have the funds, the reputation, or the distribution channel, forget it. It's not possible. So the only ones that are going to do it without either having a winning product already, the distribution channel, are going to raise a lot of money. It's the only way.
Would the rest of the panel agree with this? Is it basically like, and if you don't have money or a big name backing you?
Well, Figue's like the smartest person I ever met, so I pretty much agree with everything he says, and makes it easy for me. No, I just wanted to add that as far as like this question of how do you gain traction, like stablecoins is like a really great place because of the composability of DeFi. Like, of course, where Curve got its start was stablecoin trading, and figured out that if you have a good algorithm for trading stablecoins that match the stablecoin's risk profile and are able to deliver low slippage for high volume trades, you can actually like build an entire empire off of that, and it helped Curve with like its ability to launch other things. But it also means that if you can get some traction for your stablecoin, there are all the infrastructure pieces out there which you can like launch liquidity pools against USDC, against USDT, and stablecoin trading is such an amazing business, and it actually does empower people to go out and do things. So if you actually do have access to the distribution channel, build, launch. It's a great time to launch a stablecoin.
And we haven't even talked about network effects because it's compounding. The reason why you can't compete with USDC or USDT is they've been doing that for more than 10 years. Like, how are you going to replace them on centralized exchanges? You need to go on new centralized exchanges. Some tried with FTX, didn't turn out pretty well, right? So it's, in a sense, you need to find this new wave of things to ride on. You need the new trend, and that's the only way. That's the only way any protocol actually gets out, is you find a new hot thing and you ride out. Which one is it going to be for stablecoins? I'm not sure. What I know is that with what's happening with the Trump administration, there's a lot more leeway. What echoed a lot with me is when the administration was very adamant on the fact that they will not want to make a public stablecoin happen. They don't want a CBDC. They want private stablecoins to happen, which means that either not going to enforce very strong regulation, or they're going to find the right framework. There's rumor about it coming soon. That's going to help it a lot. So it's a good time to raise, to get into stablecoin. It's a good time if you have the distribution channel to actually go into it. And it's a good time if you're already the top dog, especially.
So Fig mentioned like distribution, like unique distribution channels. He mentioned cash, like money that you can throw at your stablecoin to grow liquidity. But as a new player, like we are issuing a new stablecoin. It's a CDP. Like, how are we going to compete against the liquidity advantage of incumbents? Like, there's like a third factor, I would say, which is like you said something like endogenous yield, or the way I like to think about it is like real value being created. Like, if you're like, how did Athena compete and like scale so well when there's already USDT, USDC, SDAI around? Like, they fundamentally deliver some new value proposition to the market. And if the market wants it, if there's 10x better than incumbents, then liquidity will flow to that 10x better solution. And that's how new players can beat incumbents. So if you don't have distribution, if you don't have money, not all hope is lost, but you need to be like innovating on mechanism and actually finding some source of new value to deliver to your users. But that's not enough. On top of that, you need to do all the tactical things. Raise a lot, pre-commitment from LPs, co-marketing with your collateral, co-incentive programs, points. All of this stuff is essential, because if you don't do it, your competitor will. But I think it's a waste of money to do that unless you're offering a fundamentally new like form of value to the market. So, yeah.
And just to build on that, like, I think there's still so much ability to innovate in this space. I think we've barely scratched the surface of stablecoin design. I think that in the past year, since I said this in my previous talk, like I said, there's a lot of opportunity. Athena is one of those that like no one thought about it until they did. Protocol FX, no one thought about that until they did. There's still amazing opportunities that are coming out on chain. And there's still a lot of, as Figue was mentioning, a lot of institutional players that are looking at the unit economics of Tether's business and saying, we want a piece of that. If we get 1% of what Tether's got, we're in good shape. There's going to be a silly amount of money flowing on chain, and there's opportunities to get it from both the real world asset side, touching those traditional rails and bringing money on, and there's opportunities in the DeFi side to build more innovative mechanisms to do it, and opportunities to bridge those gaps. So it's a really exciting time for stablecoins.
I think you hit it on the nail, really, in the sense that the unique economics of stablecoins, it's tech, right? So it means that the cost to pushing out something, unless you have to pay for the distribution channels, are extremely favorable, and you can earn 2 to 15% on AUM with a stable coin per year if you do things right. So you have 100 million, you're already making between $2 and $15 million of annual recurring revenue. It's crazy. And as soon as you start having the right network effects, it's just very stable revenue that's coming in. So you don't need to be Tether size, even Ethena size, to actually create a profitable business. My personal conviction is that absolutely any project of a certain size has an incentive in building their own stablecoin instead of accepting USDC, USDT, because they can actually get that margin out. So as long as you have the right network effects, the right assets on your platform, product market fit, build a stablecoin.
What would these network effects be? What would you recommend? Say someone's bootstrapping, a big project wants to build their own native stablecoin, but they're not an Aave. Where do they begin?
You need to find LPs. I think Ethan was very, very clear about that. You need to communicate properly. What else?
It's a challenge. I mean, there's use cases for stablecoins, and the more utility you build around those use cases, like the more that you're going to see people saying, "Oh, I'm not going to stake it. I'm going to put it in X or I'm going to put it in Y," which is why Tether can get away with it. They've had these network effects that have been built up over 10 years. So in long ways, it's about staying power. Like the longer you stay in the game, the more people are going to start integrating your stablecoin into their app. So anyone who's launching today has an advantage over anyone who's launching a year from now, just as anyone who launched 2 years ago has an advantage over anyone who's launching today. Not a reason not to launch, though. Launch it today.
Gaspard, do you have anything to add?
Yeah, I mean, obviously I'm preaching for my own church here, but like many stablecoin projects that we've seen launching in like the past months or year, they like leveraging liquidity marketplace is a great way to gain traction, gain visibility on your yield, and that's like kind of what this is about as well. And we had this Resolve case where we obviously were competitors to Pendle, and Pendle was integrating mostly huge projects, or like half of the TVL was Ethena. And so we integrated that new stablecoin protocol called Resolve, and they were like a 20 million TVL, and actually for a long time. And we started to see more and more users like getting interested to that new yield, new stablecoin, new dynamics. Like they have this two tranching system with the senior tranche and then the junior tranche, the LP. But anyway, and we've seen like more and more projects, starting speculating on that yield, which inevitably created more and more liquidity. And leveraging Spectra as the liquidity marketplace, it grew from like 20 million to, I don't even know the number now, but like hundreds of millions of TVL. And eventually they got a pool on Pendle, and they're doing very well. I think as any DeFi protocol, you have a stablecoin. There is an existing playbook of things you need to do. Obviously you will need liquidity, because how do you evaluate your success if not by like how many stablecoins are in circulation? But aside from the distribution channel, in the part that I don't know much because I'm not launching a stablecoin yet. There is this whole like, how do you integrate into DeFi to be a component that just routes liquidity to your pools?
Say not yet. Is that alpha?
No, it's because Figue mentioned like everyone should do a stablecoin, and But actually, no, we're not doing a stablecoin.
Yet.
But we do have stablecoins that are going to launch working with Spectra assets, as the principal tokens, and those mechanisms can be very interesting collateral or like fixed income instruments that can be used in different stablecoin mechanics, and that's something we're trying to push, because us too, even if we're not pushing a stablecoin yet, we have to be integrated and as a Lego in the rest of DeFi, and that means having a stablecoins on Morpho, and that's something we have for a while, but other lending markets and like more structured product built with Spectra tokenized asset, like all these things, it's very important. And I think stablecoins, because they have a lot of competitions, they really need to apply that playbook as well.
Like as a project launching a new stablecoin and trying to build the distribution, maybe I'll like share how we're thinking about it. Like I think the holy grail North Star KPI for new stablecoin is like monetary premium. It's like some structural demand to hold the stablecoin for some reason. And like, as I said earlier, you should have some unique value prop, and that should create some demand. But how do you create more demand? More monetary premium. Like DAI is famously incumbent because they have like so much people just like holding DAI, creating that monetary premium. But anyways, how do you create it? It's you need to build integrations that let people do more things with your stablecoin. So step one, you build liquidity on Curve. You let people swap your stablecoin for another. Step 2, maybe you support the collateral as lending on Morpho market. Like it's permissionless finance. We can create market by ourselves. And like let's say in Ebisu's case, we are offering cheaper interest rate than borrowing dollars on Aave. So that means that lenders on Morpho will require less yield. So then borrowers on our Morpho market can also borrow at a cheaper rate, something like that. And then what do? Like we have a yield-bearing tokenized stability pool token. We put that into Spectra. Like it's about, the whole point of DeFi is like the Legos, right? So it's about being strategic about like how you can build things to do with your stablecoin to like solidify that monetary premium. It's like, this is at least how we're thinking about it.
Yeah, Ethan, I think you're really hitting home an important point that at the end of the day, it all comes down to true, unique value creation, which is kind of sometimes ironically the hardest part of crypto at the end of the day. So it gives us a bit of hope for the new projects and the new players entering a very like incumbent, heavy, dominant space. Well, we're on our last minute of the panel, so I just want to thank everyone for coming here today and sharing your deep experience in this subsector. And if there's any last words you want to add on the unique lens of yield-bearing stablecoins, now's the time to do it. But otherwise, thank you again for joining us.
Just buckle up. I think it's going to be a great year for stablecoins.
I actually think it's ironic that we're talking about yield-bearing stablecoins because if you think about money, there's three main features: unit of accounts, payments, basically, and then reserve. We're obviously all talking about the dollar. There's no discussion about any other asset, floating currency, any other fiat. So the account is the dollar today. When we're talking about payment, it's very obvious that either fintechs or Circle Tether has one. And when you look at the reserve, we're saying, hey, it's the dawn of yield-bearing stablecoins. But today, the biggest reserve in the world is gold and Bitcoin. So we're actually not competing with stablecoins. We're competing with gold and Bitcoin. So I'd like to see, I think, the two biggest and most interesting milestones for yield-bearing stablecoin is, will we be able to force Circle and Tether to start doing yield-bearing, actually revenue sharing? And two, can yield-bearing stablecoins become bigger than gold or Bitcoin? Become a better reserve? Next Stable Summit.
The $1 million question, maybe for next year's panel. Ethan, Gaspard, any last words?
I mean, positioning, in front of all these stablecoin markets, you said it comes down to creating value. I think, another way to create value is performing arbitrage. Essentially, that's also what ECNI is doing, and I think you have a lot of arbitrage to do. Like as a DeFi participant, there's a lot of yield to enjoy, but there's a lot of things you can build like on top of this, and that's already like very interesting. We've seen the growth of integration of PT and lending market, all this like with crazy fixed rate. We're talking to institutions that are like there is a huge demand for those rates. This is because they're arbitraging something, and I think that's like very relevant part of the ecosystem that we need more is like more arbitrage on that will essentially allow us to have like more organical integration and reset the scale a bit and not having to compete with a 35% yield because it's just fueled by VC money. So yeah.
Wonderful. Thank you, everyone. Thank you to the panelists, and thank you to the audience for joining us on this busy conference week. Have a great rest of your day.
Thank you.